First rates Thursday morning on your screen. It's going to be a lot of green on the screen, and it is surely a lot of green on the screen. The breadth is looking impeccable. Picture perfect market breadth, 1:13 in terms of advanced decline ratio. Britannia, Hero MotoCorp, L&T, Mindtree, BPCL, Bajaj Finance, Infosys. I'm picking up stocks from the Nifty in no particular order, but it is just moving higher. Tata Steel, is that the big dark red on the screen today? Is that the big dark red on the screen today? Well, it's red, but not a big dark red. I think markets are waiting for the conference call. Let's see if brokerages, they change their opinion. I mean, I thought that the casualty could be 4-5%, but 1% low for Tata Steel just tells you that it is not a very scary setup. The small cap index, and there you go. Hello again, 1.3% higher for the small cap index. So if you're looking at the real exciting part of the market, time to say hello to small cap again. Aisha?
Yeah, they're making a meaningful comeback, better than the large cap peers as always. While the Nifty now is catching up on with that 19,150 print as we speak. A lot of other earnings reactions as well. Let's see what Hero MotoCorp is up to. The Q2 numbers have been in line with estimates. Margins coming in 14%. So decent numbers there, 1.5% higher. Although the monthly sales numbers has disappointed, but the numbers or earnings for the second quarter are looking good. Godrej Consumer, we're going to be chatting with the management as well in the due course. Their Q2 also is above estimates. The gross margins have risen 700 basis points. There's JK Tyre as well, margin expansion of 720 basis points there. KEC International, revenue uptick of 11%, margins coming in at 6.5%, 1.25% higher for KEC as well. Consigned Nerolac too came up with its numbers, EBITDA jump up of 37%. Triveni Turbine, wherein the EBITDA has risen about over 33.5%. So these are a couple of stocks which are in focus. There's LIC Housing Finance as well, by the way. Both the net profit as well as the NII are above estimates. And the gross NPAs as well have shown an improvement. We're not seeing any excitement come by on that stock. Fino Payments as well came out with its numbers. Profits have surged 41.5%. And the other income has clearly aided the P&L here, which is up 70%, 2.5% higher for Fino Payments as we speak. It's not just Tata Steel actually, but Britannia, that also came out with its numbers. The revenues actually are below estimates, so let's see what Britannia is up to in trade. But that stock doesn't seem to be in any spot of trouble, still holding up by about 2.6% as we speak. Volumes, remember, are up only 0.2% versus the street anticipation of 2 to 3%. Eicher Motors, the October Royal Enfield international business is down 39%. Total sales are up 3%. It hasn't quite matched up with the street estimate, 0.6% higher nonetheless for Eicher. And then, of course, there's SYRMA SGS as well. We were just chatting with the management too. The margins have slipped and they don't see margins coming up meaningfully anytime soon. 4.5% lower for SYRMA as we speak right now. So that's pretty much it. I also want to revisit what the likes of Idea, Sun Pharma, Birlasoft, etc. are up to. Remember, these were big movers in trade yesterday. Vodafone continues its uptakes. Sun Pharma as well, seeing just marginal green ticks. And Birlasoft holding up 1.25% as we speak right now. Naresh, any observations you're making, the start of trade? Any stocks that you're looking to trade to?
A decent recovery on the index as well as the small cap index has made a good 1.3% move. So the stock I would be watching out for and adding on to is RBL Bank, which has corrected the most, could go towards 235, 245 in the short term.
All right, Manish Dangi joins us. Let's talk macros, interest rates, asset allocation, and all that and much more. Manish, good morning. Thank you for joining us. Do you think everything is moving on expected lines? Fed was not supposed to increase rates. They've not increased rates. Fed was supposed to say that they are keeping the interest rate window open, which is what they said. Fed was supposed to increase their outlook for US economy, which they did. So Fed is becoming rather easy to call now.
Yeah, it's a sensible Fed, Nikunj, right? Because having taken the rates higher by about 550 basis points, Fed is deeply aware, as we all are, that interest rates work with a lot of lag. And, incidentally, I was reading a research report today early morning that perhaps today's interest rates operating in US could be of last Diwali. So a lot of rate hikes which have happened in last 12 months have yet to percolate down to the economy. As a matter of fact, that the US households are actually paying only 3.5% on their mortgages when the 30-year mortgage is at 5.5%. The US corporates are paying barely as much as they were paying pre-COVID, wherein in reality the markets have repriced coupons significantly or yields significantly. So this very idea that monetary policy work with great lags, sometimes 8, 10, 12 months or even longer, is the reason why Fed is choosing to pause now. Not because they think and they are taking the eyes off inflation. It's because they understand that, all of that they've done would continue to take effect in the economy over next 6 to 12 months' time.
So what are we looking at for, let's say, here till March or here till next June? Are we looking at a trade in the bond market? Are we looking at a trade in the equity market? Or are we looking at no trade at all?
So one thing is very clear for tentative or uncertain time investors, who are not yet ready to dial risk of any sort. Carry is a great asset, Nikunj, all over the world. But let's say most specifically and most attractively placed in US, simply by buying a 2-year bond today is marginally below 5%. If you do a little bit of an investment grade portfolio there, you will get 5.70 dollar yield, and that's likely to deliver you more than 2-3% real returns over next 1 to 2 years time. So I think carry is a great asset in US, and you could say something similar for India. Both investment grade as well as high yield carry in India looks extremely attractive for the kind of cycle that we are in right now.
Manish, hi, morning. So what does it spell into the current macro picture right now, especially in the West? How is it going to translate into yields? Will they continue to be elevated at 5%? And then the India implication, of course, because, we've seen an FI exodus. If the yields continue to give you returns, I guess it's going to be status quo and FIs won't come back to India anytime soon.
True, Aisha. It's unlikely that FIs would come back until, Fed literally pivots, and because FI's trade is a lot less about valuation and a lot more about underlying dollar markets, and the dollar continues to stay strong. Very unlikely that FIs won't return, and dollar would likely stay strong for various reasons. Why the US real rates are actually higher than what they are in rest of the world, including perhaps India. US actually is also a safe haven currency, and US tends to be a little bit of a less cyclical economy, so to say. And to that extent, there is a lot of money flocking to US and out of course, many other countries, including emerging markets. So that's one. But actually, to take a step back, as you said, what exactly is going to happen? I kind of have been thinking of it for the last couple of months, and I've actually articulated that, you could very well have a 2006-7 analog at play, Aisha, which basically means that Fed even then took rates higher by 200 from 0 to 5.25 between 2004 and 6. Then also actually US economy was doing very well, and corporate balance sheets were fine. But eventually, after 1.5 years of pausing, actually you ended up having a recession in US. So I don't think we are in June 2006 when actually Fed took a pause. Perhaps we are closer to June 2007 when actually Fed started to cut rates. So maybe in 5 to 7, 8 months time, you would begin to cite situation that Fed has to cut rates because economy, even in US, actually has slowed significantly. But then it's my base case that US economic slowdown would still be sort of a mildish. But what is not sure to me, and I'm not able to gauge exactly where a GFC kind of setup will play out. We've seen a lot of small countries struggle.
So Manish bhai, you are saying 2006, 2007, but what happened after 2007 was 2008. If a 2006 and a 2000 scenario happens, and looking at the leverage in the world, which is much higher than 2008, on every balance sheet, at least in the Western world, then is a 2008 happening?
Look, this is the point I was trying to make, that it's very unlikely that US would have 2008 play out, because US balance sheets are pretty clean in terms of household balance sheets, as well as corporate balance sheets are not levered. But that can't be said for Europe, can't be said for China, can't be said for many other emerging markets. So I don't know, and I don't think a GFC kind of liquidation or credit events are going to play out in US. But then it's more likely that you have to look some other places, where it could pay out. Thankfully, Indian balance sheets look as clean as they were in 2007. So India is out of the picture as far as that sort of balance sheet stress is concerned.
But you think India returns at an index level could be capped, Manish, when it comes to equities, purely because of the US yield, and we ourselves have a very big impending, general elections coming up in 2024?
So with a couple of things. One, of course, India macro, especially the micro macro, which is corporate balance sheets, health, bank health, and therefore and high capacity utilization. All of them hint at a very likely capex surge now over the next couple of 2 or 3 years. So I would say that's a very, very high probability event that we will have corporate capex actually start to kick in, which is extremely positive for India. India has to solve only two major things as far as Indian equities are concerned. One, of course, US Treasuries, because until they stay high and real rates are high in US, US dollar will continue to appreciate, and which is a bad news for generally risky assets across the world. And second, as you said, local elections. I'm glad that some analysts are beginning to talk. We've been discussing this for the last 6-7 months, that the outcome is a lot less certain than what markets had started to price in, and which is what is being reviewed now. I think a change in guard or a change in policies dramatically would certainly be a big hiccup as far as equities are concerned, if local elections were to actually give us a different outcome versus what markets are anticipating.
Manish, morning. What's your assessment of the earnings season so far? Because given a few disappointments here and there, by and large, earnings growth has been fairly robust.
Absolutely. India surprises there as well. In terms of most emerging markets that I track, the margins have actually collapsed and are in some places are below pre-COVID levels. India had a little bit of drawdown in margins in 2022, but then they've actually risen again. They are higher than any time since 2015-16 and very, very healthy. That is also a reason why I think the capex will kick in, because margins alone sort of explain large part of corporate capex recovery, at least empirically. So I agree with you that the Indian results are so far pretty decent, and I think for FY24, analysts would sort of meet the target Nifty earning targets, or even the broad complex earning targets, as they had anticipated last quarter. There's very little disappointment, at least I envisage, except one area, which is banking, that I highlighted to you last time also when we discussed that a lot of levers of banking earning growth are actually getting chipped off. And to that extent, I think there's going to be some disappointment over next 12 to 18 months as far as banking profitability is concerned.
But if I have to extend that point in banks, that banks are growing. I mean, the credit offtake is in the range of about 14 to 15%, 25 to 30%, depending on the balance sheet size you're looking at. But if I look at the real economy, especially the rural economy, FMCG companies, two-wheeler dispatch numbers, they are not growing. So my point is that if banks are growing, where is the growth moving? Because rural India is not growing.
No, India is very very, very big, and actually the most of the leverage goes to top quartile of the population. And this whole thing, do not want to repeat this K-shaped recovery and stuff that we've discussed since 2020. I think there's a bit of a leverage cycle, resumption of leverage cycle, so to say, in households. And when I talk of households, what matters to banks are top quartile people. And also likelihood of a leverage cycle kicking in the industrial side. Service sector also, by the way, has been doing very, very well. So where is it going? It is certainly not going to the bottom quartile, but that segment is not even a bank's catchment area, unfortunately, Nikunj. So India's overall leverage, Nikunj, is very low and has sort of stagnated over a decade. I wouldn't be surprised if we don't make any major macro mistake as a country. I wouldn't be surprised if actually leverage goes up quite sharply from here over next 10 to 15 years time. So that's not the reason I said, though, that the bank balance sheets are under stress. Bank stocks are going to be perhaps staring at disappointment. The reason I said is because the margins in banks have peaked now, and for the competition that they have on rates that they're competing, the names are going to be lower. The slippage have bottomed, and credit growth also will normalize, given that nominal GDP growth is going to be only 10-12% over the next 3-4 years time, and that would mean the lot of sort of positivity priced in banks could be up for some disappointment.
Okay, Manish, always great chatting with you. Thank you so much for taking the time out and joining in today. Okay, on that note, we'll take a very quick break. Let's just revisit the market for a bit before we actually do that. We're now scaling higher. We're in fact up 165 points and above the 19,200 mark on the Nifty futures. It's Britannia, LTIM, Kotak, Axis, IndusInd Bank. They are the ones which are actually leading on the index.
Thanks for staying on with us, still tuned into the market, just revisiting what the index is up to at the current juncture and holding out around the 19,150 mark. It's quiet, and yet the traction continues to remain within the broader universe. By way of sectors, then pretty much everything is in the green actually this morning. It's led by the PSU banks. You've got real estate as well packing in a punch, not to mention the media index is up about 1% or so. But let's hear it out from Ravi Dharmshi, Nilesh Shah, Pankaj Tibrewal as they have spoken to ET Now, sharing some of their top sectoral themes and bets in the long haul.
Financials, manufacturing, energy transition are three themes which we believe have a strong tailwind, and they fall in the bucket of where the outlook remains strong. And financials in fact falls in the bucket of where the valuations also from a historical perspective remain very attractive. For manufacturing and capital goods, probably that's not the case. Some of the growth is already factored in, but the tailwinds are strong enough for us to say that any kind of a correction, serious correction would be an opportunity to buy.
We have been liking names around capital goods, around defense, around auto components, the tier 2 banks, very specialized players in the financial space, which is online broking, online insurance. These are the kind of businesses that we have been owning. Also, our exposure to alcoholic beverages, we think that's a standout sector from a 5 to 10 year perspective.
Which will cover different parts, which is capital goods, cement, chemicals, and so on and so forth. Pipes, which is another core part of the infrastructure. Last but not the least, incrementally, we believe that the earnings downgrade cycle in IT could be behind us, and we believe FY25 could be far better than FY24, and we are looking at opportunities in the IT space incrementally as well.
Okay, that's the take coming in on where the markets are headed. In the meantime, REC, that's one of the significant movers today. The stock is, in fact, the top F&O gainer. It's holding up a solid 5% in trade in the spot market as well, 5.5% higher. And they are aiming to be zero NPA by FY25. That's the word coming in from the chairman and MD. Let's hear out this exclusive chat that my colleague Ankur Mishra had with the CMD.
It's our target to increase our renewable energy portfolio by 10 times in next 7 years, from 30,000 crore to 3 lakh crore by the year 2030. In addition to that, Government of India has allowed us to diversify into non-power infrastructure and logistics also. That has also given us additional space to grow, and hope that with a clear-cut focused initiative, and we are also targeting the good asset quality. In addition to that, we are targeting that our NPAs should become zero by the year 2025.
Now, this is something being net zero by FY25. You have to take efforts from quarter on quarter, and as you mentioned, by 7 quarters consecutively, there is no fresh NPA. What is the strategy that is working, and what is the target for current year per se? How are you pursuing that?
Yeah, as of today, we are having 19 stage asset for which we already made provisioning of about 70%. Out of this, 9 assets we are planning to resolve in the current financial year. 4 projects we are at the verge of resolving, and another 5 projects will be able to resolve in the current financial year itself. Remaining 10 projects are also at different stages of resolution, and we are 100% confident that we'll be able to resolve all these assets by the year 2025.
Well, the stock is abuzz in trade today, aims to be net zero NPA by FY25, 5.5% plus on REC. But meantime, let's also put the spotlight on the entire pharma space, and interesting data as well being generated that generics have been flat, and you've also seen the injectables business seeing a strong growth. Nikunj, something that you're pretty passionate about as well. So, put the data into perspective.
So, just for the benefit of our viewers, we must just establish what is generic. Generic essentially are drugs which are now replacing the old patented drugs in the US market. Unfortunately, post-COVID, there has been a big decline in terms of pricing pressure and in terms of generic availability. Everybody expanded the capacity in COVID, they added new lines, they added a new lines for COVID medicines, but that in a sense has not been true. But now what is happening is that the sector which was growing at about 4-5% came down to about no growth, and now looks like even the growth is not come back, the pricing power seems to be coming back. The categories where the growth seems to be coming back, one, you would imagine, let's change the graphic please, where categories where things are changing now, I think injectable growth is stabilizing. If you look at formulation growth also seems to be stabilizing. Companies which are in a sweet spot right now, largely where things could really benefit in the near term or the short term, I guess it would be Sun Pharma because of Revlimid. Lupin has got Pivira, and then Cipla, the inhaler, if things are coming back. So for large cap generic companies, the Q2 has been strong and the tide clearly seems to be turning, and the pricing power I think seems to be getting over. The generic trend which has been negative, the expectation is that now things are looking up, and there is a general view that things, at least for the large companies which have a presence and a significant marketing tie-up, things actually could be getting better. So I would say that the darkest dusk before the dawn, at least for large cap pharma, now seems to be getting over.
Okay, that's the view coming in on the entire space as a whole. Meantime, within the broader markets as well, lots of clusters of activity that you can see, many result reactions as well. So you've got something like a JK Tyre, that's a solid 8.5% higher. We just flagged off REC PFC that are a buzz in trade today, a Natco Pharma, a Britannia, Chalet Hotels, etc. And Nikunj, just to take back to the point that we were discussing, that despite a lot of concerns looming large across the globe, when it comes to numbers, when it comes to earnings, mid caps, large caps, barring a few disappointments, it's been pretty steady.
The earnings are actually, if you look at the aggregate picture is not bad at all. You look at Morgan Stanley or what Jefferies have to say. Jefferies expectations are high, but Morgan Stanley realistic expectations right in the middle. They're talking about 50% of the universe has managed to beat expectations, and large part of the very sliver of the earning this time around has been very bad. Just think about it. I mean, which are the sectors which have disappointed historically? It's been power, we haven't been surprised there. It's been autos, we haven't been surprised there. It's been FMCG, which isn't for surprise. IT expectations were low, numbers have been bad. But for banks, I think it's pretty much in numbers have been strong. So the large blocks which made up the market, consumer, finance, IT, although with the exception of IT, the large blocks in a sense this time around have given good set of numbers.
Okay, that's the view coming in when it comes to the earnings season. By and large, it has been steady across the board. What else is active in today's trading session? And there are loads of stocks that are buzzing in trade, but Sun Pharma, that's the stock that's the cynosure of all eyes. It's been a steady performance. CS Muralidharan is the CFO now joining us on the show. Thanks so much for being with us on ET Now. Let's begin with your US business, because excluding Taro and specialty sales, there has been a good sequential pickup. Can you help us understand what has led to this and what's the outlook for your generic business?
Generic business as such, I would say, has performed well, except for what we have talked about, the impact on account of Halol and marketability issues. There were some sales of Revlimid, but not significant contributor, and these sales were episodic, as stated in yesterday's call.
Your India business posted a double-digit growth, which clearly has led, was led by price increases. How is it that you see your volume growth supporting your performance in the second half of the fiscal, and then what's the growth outlook here?
In the quarter, we said that India business has done well across the various therapeutic segments. The growth is supported by both new product launches and by incremental volumes, and to some extent by price.
Any update on plans to acquire the remaining stake in Taro, which you spoke about in the last quarter?
So at this point of time, Taro being a public company, we will be unable to comment more on this acquisition of shares, remaining shares of Taro. However, as we have shared, the Taro's board has appointed a special committee, and currently they are working on it, on Sun's proposal, and we do not have any further update beyond that.
So tell us about some of the upcoming launches as well on the specialty sides of the business. What kind of revenue opportunity are you looking at?
So as far as specialty sales in the current quarter is that about $240 million. We have done about 19.3% growth over the corresponding quarter previous year. And as of now, in H1, if you look at our sales are about 471 million, again growing about 20.2% over the corresponding H1 of previous year. Full year last year, we did about $871 million in specialty business, and all our key products, Ilumya, Cequa, Winlevi, are contributing to this growth.
So by when can we expect the potential launch of Ilumya in China?
We have said that yesterday that the product has been filed, and we are working on it at this point of time.
Any comment you wish to make on the US FDA warning for the 26 OTC eye drop products, and how is it that you see the situation right now?
I think this was responded in yesterday's call also. So while some of the companies, you are right, has got some warning from the regulator on the OTC products, but doesn't mean that they'll be vacating the full market. We need to wait and watch how the market unfolds.
Okay. We are also hearing the highest number of drug shortage in the US market, and on the generic side, largely it is concentrated in injectable. Is that true according to you?
So as far as the product market is concerned in US generics, the market continues to remain as competitive as it was earlier, and pricing is specific to product portfolio what we carry with us at this point of time.
And so are you just telling us that the competitive intensity has not really reduced and there hasn't been any major pricing improvement?
What we are maintaining is that pricing is a function of the product portfolio what we carry, and at this point of time we are not experiencing any change at our end.
All right, good to have you on board. Thanks so much for taking time out and joining in. Those are some of the key takeaways from the management of Thomas Cook. Lots of other corporate voices lined up. When we return, we'll take a very quick break and be right back.
Back with First Trades right here on ET Now, addressing a whole host of earnings. So let me welcome on board Prashant Tripathi, the MD and CEO at Max Life Insurance, joining in on the show right now. Prashant, hi, morning. Good to have you on the show. You've managed to grow your APE faster than your peers. Is this performance expected to continue? And which products drove the growth for you?
Thank you. That's a very good question. Actually, if you look at the quarter, the private industry average growth on collected premium basis, new sales is about 16%. And as against that, we've grown about 32%, which is almost double the rate. And this is an outcome of a very well thought through strategy that we deployed actually to drive growth in both our online, offline proprietary channels, as well as with our partners, as well as focus on acquiring new partners and relationships. So if I look at where we are in the business and I look at the momentum, I expect that the momentum should continue and we should continue to outperform our market peers.
The share of ULIP and par saving has risen at a cost of non-par, which has been consistently falling in last 2 quarters. So what is the strategy of product mix going forward?
So your observation is correct, and that is an outcome of some of the tactical moves that we made as per our product calendar in the first half of the year. We had 2 specific products that we launched in the first half of the year. One was on par platform, and the other one was an index-linked small cap fund that we launched. Because of these 2, the share of ULIP as well as the share of par has gone up. To talk about ULIP, we have seen a distinct bias towards ULIP because the markets were kind of moving up. As we go in the second half of the year, we have, as per our calendars, we have other product launches more in the zone of non-par, and I anticipate that the product mix will get rebalanced. So you should anticipate to see some movement to take place from ULIPs and par to more non-par, and that will rebalance our product mix, as well as have a positive impact on our margins too.
All right, and your VNB margins, they were compressed at about 25.2%, the highest year-on-year decline among your peers. So can you help us understand what transpired?
So basically, let's take a step back. We finished our year last year at 31, little over 31% margin. And ever since this year began, I have been guiding, saying this kind of margin for Max Life Insurance will be unsustainable. And the guidance that we've given to the market for the full year is between 27 to 28%. Where we are right now is as per plan. It was supposed to be compressed. So really the reference of last year is not appropriate for us. As we move forward, like I mentioned to you, margins get driven predominantly by product mix. And product mix is dependent on market demand, but also on product launches. And in the second half of the year, we have a slew of products which are being launched, which I hope will have a positive impact on margin. So while your observation is correct that compared to first half last year, we are about 270 basis point lower on margin. You just took the reference of comparison of Q2 to Q2. This is aligned to how we are trying to work through and navigate the business. There's a lot of focus on building distribution. There is a lot of focus on market share, and some bit of compression on our margin was expected. I'm hoping that with all the initiatives that we are going to take in the second half of the year, it will get corrected and go back to what our guidance was.
Right. Prashant, so what is the guidance for margins for FY24 and beyond?
Actually, by the time we finish the year, I expect our margins to fall in the range of 27-28%. And, I think it will remain at that level and improve marginally, maybe 50 to 100 basis point going forward. That's the anticipation.
What is the update on the regulatory approvals for the capital infusion by Axis Bank? When is the RDA approval expected to go through?
So we have filed for approval, and everything is in order. There are 3 regulatory approvals we require. Actually, one with IRDAI. We also require approval because we have a pension fund management business. We require approval from PFRDA, and there might be an approval required from CCI. We are in the process. We have filed for approval from IRDAI and PFRDA. The approval for CCI is going to be filed soon. And I'm hoping that by Q4 of this year, which is last quarter, we should have all the approvals in place.
The bank insurance channel as well has seen strong growth. How much of this has been driven by the Axis Bank channel? Tata AIA has not started selling at the Axis branches. When this does happen, do you see any challenges?
Basically at Axis Bank level for Q2, we saw a growth of 28% from Axis Bank, which is very solid growth. And, that has given further momentum to Max Life Insurance growth. And this growth is superior to all other bank assurance counter growths. As you know, for last many quarters, our counter share at Axis Bank has been stable at around 69-70%. And with the bank believes in open architecture, and in case it were to open further to more players, we expect our counter share to remain in the range of 65-70%.
Right. Earlier, you had mentioned that you're also trying to build distribution, your proprietary mix-led growth this time around. But going forward, how is it that you think your sourcing mix is going to look like?
Just to clarify, I think Q2 growth was quite organic across all the channels. So while on proprietary channels, on written premium basis, we grew 32%. Our bank channels also grew 32%. As a result of that, Q2 growth on collected premium basis was overall 32%. So I'm just confirming that all our channels are doing very, very well. If you were to look at the first half of the year on APE basis, our prop channels grew 42% against 15% growth from bank channels. So, of course, in the first half, the proprietary channels have grown faster. And as a result of that, their share in total business contribution is close to 40%, which is higher than how it was a couple of years ago. We anticipate and we also plan to invest more and more in our proprietary channels for them to become a driving force and an engine for growth for Max Life Insurance. We're making investment in our agency, our direct sales force, our digital channels, and we are recording significantly high growth in all those three channels.
Thank you so much for taking time out and joining in and running us through your business outlook. All right, let's move right on and put the spotlight on earnings. Tata Motors set to report its Q2 numbers today. The lower raw material costs and cost control measures could aid their margins. What else is the street penciling in? Srishti joins in with the details. Srishti?
Yes, Tata Motors will also be in focus on the back of the earnings, because do remember the sales were actually 7.5% up on a sequential basis, and this time India business performance has seen a mixed bag because the commercial vehicle volumes were up 3.5% YOY while the passenger vehicle volume fell 3%, and the JLR sales as well we have seen in the quarterly update, wherein because of the plant shutdown the JLR volumes were impacted a bit as well. So all in all, we are expecting a decent set. Talking about the margins and the numbers that you need to be tracking, so JLR EBIT margin is expected at 7%, which is actually lower than what the company reported in Q1 FY24 at 8.6%. Though we can see an expansion in their India CV as well as passenger vehicle EBITDA margin. CV EBITDA margin expected at 10.8% and PVA EBITDA margin expected at 6.7%. Given the operating leverage, the cost efficiencies as well as the improvement in the segmental volume, we can see the margins getting a bump up, but definitely the JLR cash flow will also be a key to track, because the company has already said that they are presently expecting a positive free cash flow of around £300 million for Q2. So update on that will also be tracked upon. Talking about the numbers quickly, then onto the revenue figure, we are expecting 1,76,087 crores onto the top line. EBITDA expected at over 14,000 crores. Consolidated margin we are expecting at 13.2%, almost flattish on a sequential basis, and onto the profit figure 4,315 crores is the expectation, and that will be a jump on a quarter-on-quarter basis of 40%. So that's the expectation of Tata Motors. All eyes on the numbers.
Oh yeah, absolutely, and some reacting to their numbers as well. But let's hear out a slice of market opinion on what is it that you should be looking at when seeking some opportunities within the broader end of the markets.
The small cap index itself churns so much that the stocks that finally make that cross that high again are a completely different set from the stocks that fell. The stocks that fell, a lot of them just go out and go to zero essentially, stop trading, etc. So that part of the market I've been saying for the last month and a half, that's where you have the real risk part. The Large caps, of course, you have to choose the sectors carefully, you have to choose the companies carefully. I and my systems also don't still like private sector banks. In fact, the last rebalance we did, we cut back banking in general, and within banking, again, skewed little more towards PSU banks.
We like pharma as a sector because we think there's earning resilience in the sector. And more importantly, the sector is coming out of 2 years or 3 years of underperformance and business challenges. And now a lot of those headwinds which the sector faced has turned into tailwinds. So we see good opportunities in pharma across both large caps as well as mid caps, and valuations there are far more reasonable. And apart from that, we like some of the mid-cap banks as well, financials as well, because we think asset quality in the sector as a whole is extremely strong or resilient.
We have been a little cautious on the broader market space for some time now. And our broader concerns were that the valuations had become too rich and greed was clearly visible on the street and money making had become too easy. Over the last decade, mid and small caps have been the best equity class, and we believe that some exercise and some caution needs to be warranted in the near and short and near term. Even if you look at large cap market cap ratio versus GDP, it has come down to very reasonable levels, and we believe that some rotation may happen from mid and small cap in the near term towards large cap, which are in a much better valuation zone.
All right, let's just quickly check in as to what are some of the newsmakers then in today's trading session. Remember, you had a Tata Steel that came out with its numbers, a lot of disappointments there when it came to the overall business growth, as well as the Europe business and the India business growth. 115 is where the stock is at. You also had something like a Britannia, which came out with their numbers by and large in line for the margins as well, 14%, and the management as well alluding to the fact that there will be strong growth. Hero MotoCorp, that is. Consumer confidence is coming back, and they say that that will augur well for growth down the line. The stock, though, pretty tempered in trade. There's JK Tyres. The margins expanded quite substantially to about 15%. Revenues were at around 3,800 odd crore rupees, and the stock clearly cheering those numbers. There's also been expansion of their existing capacities. An inline set of numbers when it comes to GCPL, a 19.6% margin. You've got the revenues as well, which came in higher, about 6%, and the stock quoting at about 993. Well, let's put the spotlight then on one such set of numbers. We just spoke about a JK Tyres, and we've got Anuj Kathuria, who is the President India at JK Tyres, here to discuss the road ahead. Thanks so much for taking time out, and it has been stellar growth yet again in Q2. What has led to this, and which are the segments that's fueling the performance?
So we reported a net top line net revenue of 3,905 crores consolidated basis, and our EBITDA margins were at 15.3% for the quarter. So here we have seen that the top line has grown by 4% on a YOY basis, and we have actually, this has come through our sustained efforts for a larger market presence, and this has enabled to boost our volumes, and this has come across segments and across product categories. We also had a very strategic focus on enriching our product mix, again across all the product segments, and not to forget talking about the operational efficiencies. We have been working on that. Cost compression, operational efficiencies have also helped us to boost our margins.
Right. Mr. Kathuria, on margins, while they've seen an improvement on a sequential basis, do you see this sustaining in the third quarter? And how is it that you see your RM cost basket moving forward?
Very pertinent question. So the RM cost has been, in quarter one, we saw that it had come down, and there was a further softening in quarter two. Going forward, yes, there are certain challenges. We'll have to watch it very carefully. So this is the wait and watch game, especially when it comes to the crude oil, which way it goes. But even if suppose there is a little bit of a hardening which is expected in the RM prices, we will have to bank upon the continued robustness in the demand. Demand is expected to be robust. We as an organization are also working on further premiumization in our product segments, and also the efforts on getting the efficiencies improved further. That also would continue, and with a better capacity utilization. So all these levers would act as the tailwind, and this would, to some extent, if there are headwinds on the RM side, it should be able to kind of sustain the level of margins that we have reported for quarter two.
Now, you announced a new capacity addition which will enhance your capacity by 20% by October 2025. What product line are you planning to use this facility for?
Yeah, so this capacity expansion proposal that has been announced, majorly this would be in the area of the passenger car radial tires. This would come up in our plants, both in Banmore as well as in Chennai. That is where we produce the passenger car radials. More details would be shared with all of you going forward. But definitely we are at around 95% utilization as of now in the overall utilization. So keeping that in mind and seeing that the demand in the market is robust and is likely to grow further. Also, we have a gestation period once we start working on this kind of a project, and that is why we have mentioned that these capacities would come into play by October of 2025. So keeping that in mind, and there is a robustness in the demand, so these capacities would definitely be required.
So in this capacity, will you be manufacturing and focusing on the SUV category? What is the share of SUV?
Yeah, so, we have seen that in the OEM passenger car manufacturers, the share of SUVs has been going up steadily. Now it has reached a level of 55 to 60%, depending on which manufacturer we are talking about. So these SUVs, not only the numbers are growing, but the new facelifts and the new models of these SUVs are coming in higher rim sizes. And as we go to the higher rim sizes, naturally the margins are better. That is what we call as premiumization of the product. So we are working on this, and even our existing capacities and definitely the new capacities that are on the anvil will have the capability to produce these higher rim sizes. In fact, in the new capacities, we would be having the capability to go up to 22 inches in the PCR segment.
Right. And what are your plans regarding EV tire manufacturing for the passenger vehicle segment? Anything that's materialized here?
The EV segment definitely holds a lot of promise, and it would be eventually playing out. We will have to wait and watch as to the time frames, but we are getting our products ready. Many of the products are under validation. Some of them are also under serial production. The tires, the JUXE, which is used on the intra-city buses, the EVs, which are right now being planned in large volumes by each of the state transport undertakings. So that would be the high volume requirement as far as EV tires are concerned for the TBR range. We would also be having requirements coming up in the passenger car. So we have got our products ready. The good news is that all our capacities which are existing as well as the new ones, do have the capability, and it is the capability is interchangeable between the current range of tires and when we have to produce the EV tires. The EV tires basically have a lower rolling resistance. They also have lower noise levels and definitely have to be lighter in weight. But having said that, it does not require a different manufacturing facility. Definitely the products have to be designed, developed, the compounds that go into it have to be different. But as far as the manufacturing facility is concerned, it remains the same.
Just as your debt levels have risen with your new capacity addition, how much do you think you will be able to pay out once the capacity kicks in?
See, first, before that, I would like to also share with you that we had already shared with you our debt reduction plan, both for the short term as well as the long term. Even during this quarter, the overall debt has further reduced. If I go to March 2023, it was at around 4,500 crores, and this has come down to around 4,080 crores. So there has been a substantial reduction in the debt, and this is as per plan. Further, we would also like to definitely another important point is that our net debt to EBITDA has improved significantly. It used to be around 3.4x. It has come down to 2.27x. So that is something which is definitely giving us the confidence that going forward, even when we undertake these expansion programs, we would be able to finance these as a combination of debt, but more importantly, through either equity or through internal accruals.
All right, and the last time you had said that export demand is expected to pick up in the second half. So what are your plans to grow this number?
See, just let me try to give a context first. If you see the last financial year, the first half was quite robust for the export demand, but it had come down sharply during the second half of the year. But quarter one, we saw some recovery, and quarter two has been even better as compared to quarter one for exports. And our consolidated exports, both India operations as well as Mexico operations put together, there has been a robust double-digit growth in quarter two as compared to quarter one. So last year, second half was a low 6 months period for exports. So we expect that this year, the second half of the fiscal should be definitely better than the previous year's second half. So we are very confident about this and we are looking forward to it. Definitely there would be the impact of the seasonal demand, the holidays. Quarter three definitely is not a very robust quarter for exports. There is a year-end change. But quarter four going forward should again be quite good for exports.
Right. You're planning for more price hikes given the crude oil rise. Is that a fair assumption?
See, again, to put a little bit of context over here, in the last, say, few quarters, maybe 10 to 12 quarters, we had seen that the raw material prices were constantly going up and the price increases were being taken. But from quarter two of last financial year, the raw material prices first started softening and then they have come down steadily. But we had gone through the process of the price increases in the last financial year. This year, there have been no major price increases per se. But having said that, there have been select SKUs where there have been certain price improvements that have been done. Also, our overall sales realization gets better when we are enriching our product mix with the premium products, whether it is in PCR or whether it is in TBR. We are focusing more towards going for the premium products. Definitely, those products give us a better margin.
All right. Thank you so much for taking time out and joining in. Well, it's a busy day for sure. We're packed with one corporate to another, and Thomas Cook in the spotlight to discuss their quarterly performance numbers as well as the outlook for their individual segments. We've got Mr. Madhavan Menon. He's the Executive Chairman, Thomas Cook India, now joining in. Mr. Menon, good to have you. It's been a healthy growth overall. You've reported a profit as well this quarter. Question is, do you see the traction continuing? Do you believe that this revenue growth as well will accelerate in the coming quarters? Mr. Menon, we cannot hear you. Okay. I think if you can just unmute your mic, maybe.
Yeah. Good morning, and thank you for having me on the show. Yes, we did report a decent set of results yesterday. My expectation is that we will see continued growth in terms of the recovery process. You'll appreciate during the pandemic, we went all the way down to zero and have recovered from there. This recovery process continues. But part of the reason is the fact that we are seeing stronger demand. Even if I look at the forward bookings for the upcoming quarter and this and the next quarter after that, we are seeing a 32% rise in terms of demand as reflected in our forward bookings for travel services, which is the leisure business. So I'm fairly comfortable saying that this trend should continue for a couple of more quarters, at least in terms of strong growth.
Can you give us a sense of corporate travel? Because that is the big, in a sense, ledge for Thomas Cook. When you say forward booking, are you referring to corporate travel as well?
No, Nikunj. I'm referring to the packaged holidays. And I will let me answer your question around corporate travel as well as add something else to that. Corporate travel actually led the recovery for us because as we came out of the pandemic, corporates started traveling. We also saw several Indian corporates start trading with us. And so we've seen a growth in corporate travel. If I just look at the recovery in terms of volumes from pre-COVID to now, there is 135%. So we've actually exceeded 2019 numbers. The other aspect of travel, which has really grown dramatically, has been in the incentive business. You're aware that Thomas Cook handled a large number of the pre-G20 meetings that India had between January and August this year. Additionally, we've done 2 Khelo Indias. We are currently doing the national games in Goa. So we've seen our incentive business also grow very strongly. That has been in about a 12-month period, but the corporate travel business has grown over the last 18 to 24 months.
Mr. Menon, I'm surprised to see you on TV. I was of the view that you should be in Wankhede Stadium wearing Indian jersey, maybe in a Thomas Cook box with your family.
It's at 2 p.m. He will go there.
He'll reach early. Support for India, right?
Thank you, Nikunj. I appreciate your compliment. Unfortunately, I haven't been to a single match as yet. We're still toiling, but I think having said that, Nikunj, we've seen growth across various companies. If you look at Sterling, there's been strong growth. If you look at our destination management businesses, which were slower to recovering. If you look at DEI, which is our imaging business based in the UAE, but across Southeast Asia, despite the UAE being in an off-season, we've actually seen strong growth there also, primarily because China has, domestic travel within China has come back in a big way.
I want to specifically understand what everybody seems to be talking about right now. You referred to G20 and Khelo India. You've done 2 seasons, and there is a World Cup which we spoke about. How much of your revenue this year has come from events which may not occur next year? And next year, sir, there is elections, lot of events, lot of decision making may actually not happen from April to, let's say, June or July onwards.
So if I look at my MICE volumes, the Khelo India and this thing will be barely 15%. So I'm not too worried about that in terms of profitability. or the volumes, because we know that corporates have scaled up their incentives programs. And I don't think, while the elections will affect some of the government-related business, and G20 is obviously not coming back, my expectation is that corporates will continue to trade because they're also witnessing strong recoveries. And just as the speaker before me said, that there is a trend of growth that is directly related to the incentive business and the corporate travel business. I must add that we are seeing new additions in a manner that we had not seen pre-COVID in terms of Indian corporates traveling with us. Lastly, I think what is important is that the pandemic taught us a few lessons where we significantly re-engineered our cost structure. And if you look at it, even today, we are 30% down from pre-COVID in terms of costs, and we've added technology. So we've digitized a lot of our processes, which gives us productivity benefits, which we hope to retain over a period of time. So my expectation is that despite some of these one-offs and geopolitical pressure, we will maintain a decent trend in terms of profitability.
What is the outlook as well when it comes to your margins on the back of operating leverage? What kind of margin outlook are you looking at down the line?
So I think I expect that our margins to be stable from here on. If you look at our EBITDA margins, be it for at a Thomas Cook level for the half year, it was about 5.4%. If I look at it on the quarter, it's 9.89 for the half year and 10.1 for the quarter. It's all very, very stable. So I expect that these margins to continue because we are very focused on margins. And, we want to ensure that if we're going to drive the productivity benefits to the bottom line, margins have to maintain their current levels. And I'm fairly comfortable with that.
Joining in, Mr. Menon, margins will be stable, confident as well that growth will continue for the next 2 quarters. So yes, positive commentary all along, and the stock is cheering that news. 19,127 on the index. We'll take a break. Come right back from